I'm going to take a bit of a different view, which is to say, oh, that's my notes.
Okay.
Oh my God, that's his notes. There we go. A complementary view, I should say, which is that to approach this really important trust issue, we need to actually talk about value and the current assumptions about how value is created and the narrow ways that we think about it. This idea that, for example, value is created in companies, and then things maybe go wrong, so we have to rediscover purpose. And then in the meantime, the public sector just comes in to fix market failures, to enable and to regulate. This isn't really an idea of stakeholder capitalism. What does it really mean to co-create value between public institutions that themselves have to rethink their purpose, how they are governed? Private institutions, which of course need to move away from this very narrow maximization of shareholder value, but also third sector institutions. We shouldn't forget, by the way, that trade unions, labor unions, got us one of the greatest social innovations under capitalism, which was the weekend, not bad, the 8-hour workday. So what does it mean to really rethink how these different actors interact in order to have a stakeholder governance of the capitalist system itself, which we know has not just a rate of growth, but a direction. And it's that direction also that we really have to talk about explicitly. And let me just remind ourselves, and I think actually the previous presentations did a very good job in doing this, but I'll just do it in a more summary fashion, where the problems are in terms of this problem in directed growth. So first of all, finance, people in the room, we have an ultra-financialized financial sector. So it's already been said, not all banks are like Santander. In the UK, for example, only 20% of finance actually goes to the so-called real economy. Most of it goes into finance, insurance, and real estate. Second, industry has become overly financialized. So $3 trillion in share buybacks over the last 10 years by the Fortune 500 companies, not reinvesting in those things that Richard rightly said